The contrarian nature of this comes from the fact that markets are very much psychology. There's, fundamentals matter a lot, but so does psychology. And what I've found through my 50 years of doing this is that major inflection points, meaning tops and bottoms, it really pays to be on the other side of the crowd. So at bottoms, the majority of investors are bearish. They're kind of caught up in the bearish tape. And at tops, the exact opposite. They're typically quite bullish. But I do think that you're looking at a lot of signs, and this has been my theme for quite a while, that the Fed has over-tightened. And because of leads and lags, they're likely to stay the course too long on the tight side. That's been their MO for many cycles. And, send us into certainly a recession. And my argument is that with the leverage in the system today, which is unprecedented, it's far beyond anything we've seen in previous cycles, that leverage combined with a Fed policy mistake of going too far on the tight side is not only going to cause a hard landing, it's going to cause what I call a global deflationary bust, meaning it will not just be here in the US, it will be global because the other central banks are doing the same thing. And because of the leverage, what would normally be a recession will be something worse. So global bust to me means something worse than 2008-9. We almost saw a bust in 2008-9 when the commercial paper market froze up, but the policymakers acted just in time and kept it from going over the cliff. This time, because of that leverage and because of a Fed that really seems not to understand the risk, I do believe we're probably going to go over that cliff. And that means pretty possibly the worst financial crisis in history combined with a pretty serious recession. We're talking about perhaps the worst recession in the post-World War II era. So it'll be, unemployment will be rising probably. I don't know if it can get to double digits given what we're dealing with here, but I think a sharp rise in unemployment. You will see a sharp contraction in the economy. You'll see negative consumer spending, and certainly, business confidence is quite negative already. You're going to see a pretty tough economy across the board. We've had high leverage before, but never to this degree. We are so much beyond leverage in the past. So 300 trillion in debt, we throw around these numbers, and I don't think most people grasp what that really means, but that's massive debt. 300 trillion in global debt and quadrillions in notional value of derivatives. And that's leverage on the markets. So you've got things that we've never seen before in terms of leverage. When you make a policy error and you've got that kind of leverage, that policy error gets magnified many times. So that's pretty much the simple reason why I believe this will not just be tough sledding, it'll be a global bust. I am calling for a melt up. I am calling for a rise to substantially higher highs. But following that, I'm also calling for an 80% bear market. So that bear market will precede the bust, or will be beginning before the bust and then continue into the bust. So it's going to be a big up and a big down. What will cause it? It's all the excesses. I mean, it's the excessive debt, it's the excessive derivatives. It will be ultimately the policy errors on both the Treasury and the Fed side, but particularly the Fed. It'll be this tightening that should be reversed now because of everything that's going on, and because inflation is a slow thing to, it comes down, but it comes down with a lag. They're focused on month-to-month inflation. They're saying, well, CPI is still, elevated. Yes, it's come down, but it hasn't come down far enough. The problem is CPI is a laggard. It'll come down over time. By the time you realize, if you're going to do it month to month, by the time you see what you're looking for, it's too late. The bust will probably not last much more than a year. And so by 2025, we'll be moving back into a recovery. In that recovery, because of all the money the Fed is going to have to shovel into the system to deal with the bust, the Fed and every central bank, you will start a new inflation cycle that I believe by the end of the decade will take inflation to 25%. So we're talking about deflation in 2024 and hyperinflation, or what I would call hyperinflation, 20 to 25% inflation by the end of the decade. So, and the reason for that, we haven't even discussed this, in the bust, the Fed will have, and all central banks will have no choice. There'll be a free falling financial system, meaning bank failures, etc., dominoing around the world. The only policy response that can move quickly to deal with that is massive money. You go from, 5 or 6% mortgage rates, and actually in the bust they could get back down towards 2%. If you go from that to 15% mortgage rates, what does that do to home prices and affordability for homes? It really hits that hard because, the interest rate's the biggest component of the mortgage. So I think real estate and housing is going to get hit hard. It's going to lag certainly in the next cycle. People think real estate is an inflation hedge, but because so much of the purchase of a home surrounds a mortgage, if mortgage rates rise dramatically, as I'm expecting, I don't think real estate and home prices are going to keep pace with inflation at all. In fact, I think they go the other direction. I think we have seen home equity serve as a big stimulus to consumer spending, through all generations. Those that own homes and homes that have appreciated of late have used that home equity, particularly when rates were much lower, to take money out of their home and kind of exceed their income to spend beyond their means. That game is probably going to be over if I'm right about where rates go. So unfortunately, I think we're coming upon the end of what I describe as a supercycle, which is a cycle, the big cycle between two depressions. The Great Depression being the last depression, and the next depression probably being in the 2030s. So we're in the last decade of a supercycle. I just don't think what has worked in the past, or what has been kind of the trend of the past, is necessarily what the next several years is going to look like. And I think people need to understand the risks, because if they don't, they could get into bigger trouble. This is the end of a super cycle. We have, it's a Ponzi scheme. We have been living on our debt, ever higher mountains of debt, for decades. And it reaches a point of no return, I think, in this next, 6 or 7 years. I don't give advice, so I'll leave that to others. But what I can say is that my call is for 6,000 to 7,000 on the S&P this year, and probably by the end of the summer. Could stretch out. My MO is that I put possibilities out there, and they just keep extending. So this is a big cycle, but I'm calling for something that's unprecedented in terms of it's called a melt up for a reason. We're at the end of a 41-year secular bull market that started in August of 1982. And I believe we're coming to the top of that this year. That last stage of that is probably going to be vertical. It won't last long. It's a final parabolic blow off. And then I think we got to deal with the bust, and the market will start discounting that. I believe the next cycle will be dominated by commodities, and I believe gold and silver I'm calling for gold to go to 20,000 by the end of the decade. I think it can go to 3,000 this year. I'm calling for silver to go to probably $400 or $500 by the end of the decade. Oil could be at $400 or $500 a barrel by the end of the decade. And copper will be through the roof. Natural gas will be through the roof. All commodities, ag commodities will see substantially higher highs than they've ever been. We will see a commodity cycle unlike any we've ever seen. I think commodities will be the game in town. And I think if you're in indexes if interest rates go from 0 to 15% over a 5 or 6 or 7 year period, indexes are very much driven by PE multiple expansion, or have been in this last 41-year bull market. If you get the reverse of that, you're going to see PE multiple shrinkage, contraction. And so indexes are going to have a hard time getting back to the highs of this year. So I think the highs we set this year in this final blow off will probably be the highs for decades to come.